In my video on the problem with index funds, I compared DFUS, a low-cost total US market ETF that doesn't follow an index, to VTI, a total US market index ETF, to illustrate how not following an index can be beneficial. Despite these two ETFs being total market funds that are similar along most dimensions, DFUS has outperformed VTI since it listed as an ETF in June 2021. Many people were upset by the suggestion that index funds are not perfect investments and wanted to poke holes in my comparison. I think this is worth digging into further. In this video, I'm going to take a more detailed look at these two funds and explain why index funds, while an incredible innovation, still have room to improve. I'm Ben Felix, Chief Investment Officer at PWL Capital, and I'm going to compare in more detail than you probably want DFUS and VTI. Let me be clear about something up front. Low-cost total market index funds are great tools for building portfolios. If you're a happy index fund investor, don't let this video push you off course. I am a big fan of index funds, but I'm also aware that they're not perfect, and this channel doesn't exist to coddle the beliefs of index fund investors. That said, in the grand scheme of things, choosing between two low-cost, low-turnover, and broadly diversified funds like DFUS and VTI is probably not a decision that will change your ability to meet your long-term financial goals. It is, however, a reminder that it's important not to be dogmatic about anything in investing. I get it. Index investing stems from a scientific approach to thinking about managing portfolios. It's rooted in theories like Markowitz portfolio theory, the capital asset pricing model, and the efficient market hypothesis, and supported by mountains of empirical evidence demonstrating the inability of active managers to beat index funds most of the time. The weight of this theory and evidence should make it very difficult for people to update their prior belief that index funds are optimal investments. But even in the face of a strong prior belief, applying the same type of scientific thinking and more up-to-date theory can lead to modest improvements. DFUS is the dimensional US equity market ETF, a US total market fund that aims to deliver market returns without following an index, and while making a few evidence-based tweaks to how the fund is managed and implemented. VTI is the Vanguard Total Stock Market ETF, a US total market fund that tracks the crisp US Total Market Index. Its sole objective is tracking the performance of that index net of costs. Both funds offer broad exposure to the US market, but by not following an index and doing a few other things that I'll detail in a minute, DFUS has been able to outperform VTI since it launched as an ETF in June 2021 through July 15, 2025, while maintaining similar exposure to the total US stock market. DFUS is not an index fund, but it looks more like an index fund than a traditional actively managed fund. It differs from VTI in a few nuanced, well-thought-out, and important ways. First, index funds like VTI follow rigid rebalancing rules to match index returns, leading to some potential costs that won't show up in fees. A stock market index is a representation of a stock market, but it is not the stock market. Every day there are changes in market composition due to things like initial public offerings, new share issuance, and stock buybacks. Most indexes rebalance to reflect these changes quarterly. In between rebalancings, the index and the actual stock market will differ slightly. The timing and nature of index rebalancing ends up being really important. The 2025 paper, Index Rebalancing and Stock Market Composition, Do Indexes Time the Market, explains that indices, and by extension index funds, are subject to adverse selection due to when firms issue or buy back stock. Firms, companies that list on the stock market, will issue stock when they think their share price is high, and they'll buy back stock when they think their share price is low. It's a similar situation for IPOs. Firms will go public when they believe their share price is high. This makes sense for firms and contains information for investors. In fulfilling their role of representing the market, total market indexes quickly incorporate these changes through their rebalancing traits, buying stock when firms issue or go public and selling when they buy back. Index funds follow suit to fulfill their role of closely tracking the index. This puts index fund rebalancing at odds with firms' own beliefs about their share prices, and empirically it results in an implicit cost for index funds. The authors of this paper find that the long-short portfolios that mirror index fund rebalancing trades have a negative 3.5% annual return and load negatively on the value, profitability, and investment factors. They estimate that this imposes a 60 basis point annual index-level performance drag on the total market index. This can be thought of as the cost for achieving the primary objective of the index, which is to approximate the returns of the market it represents. It's not a cost that's easy to see because it's equally reflected in the returns of the index and the index fund. One of the ways this paper measures the cost of index rebalancing is by constructing index portfolios that rebalance less frequently and implement a lag in incorporating changes in market composition. These lazy indexes, as they're called in the paper, boost returns by 40 to 60 basis points per year, a benefit mostly stemming from waiting to incorporate changes in market composition. Another interesting point that the authors make is that both normal quarterly rebalanced indexes and the lazy rebalanced indexes that are introduced in the paper have tracking error relative to the actual stock market. But lazy rebalancing improves the return per unit of tracking error. This is a fascinating point. An index is not the market. Its returns are not identical to the returns of the market. In other words, it has tracking error to the market. This is because the index reflects changes to market composition quarterly, while actual market changes are daily. A lazy index is even further away from being the market because it further delays incorporating changes to market composition. But the increase in tracking error is relatively less significant than the increase in expected returns. This is because the lazy index is mechanically avoiding buying stocks with low expected returns and selling stocks with high expected returns in response to changes in market composition. Well, it's not quite a lazy index as defined in this paper. By not tracking an index at all, DFUS is able to avoid this issue almost entirely. DFUS delays buying IPOs and it follows trading rules designed to increase expected returns rather than trading to match changes in market composition. It also excludes certain types of stocks entirely. These exclusions are important to understand in making the DFUS to VTI comparison. DFUS excludes small-cap growth stocks with weak profitability, small-cap growth stocks with aggressive investment, and small-cap stocks with high securities lending fees. These specific types of small-cap stocks are well known for having poor returns. They're sometimes referred to as junk or small crap growth stocks. The exclusions in DFUS are not intended specifically to avoid the effects of adverse selection on changes in market composition, but they do have an interesting interaction with that research. In index rebalancing and stock market composition, the authors find that one of the reasons that index fund rebalancing portfolios perform poorly is because of their factor exposures. These same factor exposures are minimized by DFUS's exclusions. DFUS also excludes REITs. This exclusion is not based on any particular evidence, it's simply a product design choice by Dimensional. If people want to add REITs, they can do so easily with a REIT ETF. REITs were one of the common arguments I saw against my comparison of DFUS and VTI in my previous video. Some comments suggested that the REIT exclusion explains all of the performance difference over my sample period. To address this, I built a model portfolio that consists of DFUS combined with VNQ, the Vanguard Real Estate ETF, where the weight of VNQ in my model is matched to the historical weight of REITs in VTI. As you can see, adding the real estate allocation to DFUS does drag down returns over this period, but there's still a huge portion of excess return that can be attributed to exclusions and avoiding adverse selection. Interestingly, the 60 basis point excess return after adjusting for REIT exposure is identical to the findings in index rebalancing and stock market composition. It's also important to understand how much of the market DFUS excludes. This speaks to another comment that I saw some people making, that DFUS is missing out on a large portion of the US market, making it an unwise investment choice. This argument seems like it could make sense if you look only at the number of securities in the two ETFs. When I collected the data for this video, VTI held 3,564 stocks, while DFUS held 2,430. With more than 1,000 fewer holdings, it looks like DFUS is covering much less of the US stock market. But before drawing conclusions here, it's important to understand the market weight of the stocks being excluded from DFUS. VTI covers approximately 100% of the US stock market, reflective of its underlying total market index. DFUS is not tracking an index at all. It's benchmarked against another US market index, the Russell 3000, but the universe of stocks that DFUS selects from are not tied to that index. DFUS holds 179 stocks that are not included in the Russell 3000 and excludes 661 stocks that are included in the Russell 3000. The Russell 3000 covers roughly 98% of the US stock market, and DFUS is excluding 3.6% of the market cap weight covered by the Russell 3000. As you can see, while there are fewer stocks by number, they make up a tiny portion of the market. Another thing is that a big portion of that 3.6% exclusion relative to the Russell 3000, roughly 2.6 percentage points of it, is REITs, which we talked about earlier. The remaining 1% are the previously mentioned small cap exclusions. Over this period, the excluded small cap stocks have returned about negative 10% annualized. At a 1% weight in the portfolio, this represents a negative 0.1% contribution from the excluded stocks leaving a large portion of the excess returns to be explained by things like trading flexibility and avoiding adverse selection on index rebalancing. The other argument I want to address is that while I focused on the returns of DFUS since it listed as an ETF in June 2021, it did trade as a mutual fund prior to that. And over the full period since inception, it has underperformed VTI. From inception on September 25, 2001 through June 11, 2021, prior to DFUS listing as an ETF, VTI outperformed the predecessor to DFUS, which at the time traded as a mutual fund with the ticker DTMEX, by an annualized 0.47%. Whether this pre-ETF listing performance means that the post-ETF listing performance has just been luck is a valid question that requires understanding where the difference came from. DTMEX was similar to DFUS in many ways, but there were some differences that I think are material enough to make the pre-ETF conversion data difficult to extrapolate from. DTMEX was still a total market fund, but its objective was to maximize tax efficiency. DFUS does share this objective, but DTMEX accomplished the objective in different ways. For some of its history, it held lower dividend yield stocks. It was also careful to avoid unqualified dividends and short-term capital gains by holding stocks for longer than it would have otherwise. Fast forward to today, DFUS no longer aims to hold low dividend yield stocks, and under the ETF structure in the US, there are now more efficient ways for the fund to deal with capital gains. The other issue with the pre-ETF comparison to VTI is that DTMEX had a much higher expense ratio than VTI for most of their shared lives. Back in 2001, DTMEX had an expense ratio of 0.25%, while VTI was at 0.15%. But by 2018, VTI was down to 0.03%, while DTMEX was at 0.22%, for a 0.19% difference. When DTMEX began trading as an ETF, DFUS, its expense ratio dropped to 0.09%, only 0.06% higher than VTI. Another issue with the historical data is the exclusions. The current exclusions being applied in DFUS stem from research that had not been done yet when DTMEX was launched. The exclusions were added to DTMEX over time, but they were not there for the full sample. Overall, I don't think the pre- and post-ETF conversion data are comparable. DFUS is materially different from DTMEX on multiple measures. All things considered, while I do acknowledge that data going back to June 2021 are not sufficient to draw long-term conclusions from, I don't think that the prior history of this fund predating its ETF conversion is representative of its expected performance. This fund's approach and performance contain important information for investors to consider. Total market index funds are great investments because they are low-cost, low-turnover, broadly diversified, and tax-efficient. But these favorable characteristics are not exclusive to index funds. Indexes are designed to be representations of the stock market. Index funds blindly follow them with the objective of matching their performance. Recent research has shown that due to the timing of changes in market composition stemming from things like share buybacks, share issuance, and IPOs, total market indexes are effectively bad market timers. An index that delays incorporating changes in market composition and considers the expected returns of the stocks that it owns can increase expected returns. This is very different from traditional active management, which aims to beat the market by picking relatively concentrated portfolios of stocks or timing exposure to the market. Traditional active management has higher fees and costs to overcome, and by holding concentrated portfolios, often fewer than 100 stocks, risks missing out on the subset of stocks that drive most of the market's performance. This leads to underperformance for most active funds even before fees and costs are considered. DFUS is still a total market fund. It is low cost, low turnover, broadly diversified, and tax efficient. It does exclude some stocks intentionally based on their expected return profile, but it still holds thousands of stocks. Between its exclusions and its ability to avoid the market timing costs that affect total market index funds, DFUS represents structural improvements to the already incredible low-cost total market index fund. The cost of being different from the index, even if it does lead to expected outperformance, is tracking error. Performance that is different from the index can be challenging for investors. For example, I could make this video and DFUS could go on to underperform VTI for some period of time. Even people who found the arguments in the video compelling might have trouble sticking with the strategy through periods of underperformance relative to well-known indexes. This is likely a reason that many people will not, and I might even say should not, pursue a non-indexed total market strategy like DFUS. If you can get over the possibility of tracking error and are willing to update your beliefs about the best way to invest, I do think it's possible to make slight improvements to the already great concept of low-cost total market index funds. And I think that is exactly what DFUS is doing. Thanks for watching. I'm Ben Felix, CIO at PWL Capital. Tell me how dogmatic your beliefs about index funds are in the comments.